This is David Cox, Senior Portfolio Manager at Financially in Sync at Raymond James in Waterloo, Ontario, Canada. Today on the webinar, where do we investors stand? It is Friday, January the 16th, 2026. Let's get started. As usual, we'll sort off by week. My goodness, silver, again, a very big week, 22.9%. Bitcoin and gold right behind it. Down the bottom, we've got growth. Lots of things to see. Remember, pause your video player at any time for more details. I want to talk about Canada and the US. I've talked about it many times, but I will probably end up talking about it many times more. On the left side, we've got a really long-term 50-year chart. This is a relative. So Toronto, that would be Canadian stocks versus the US stocks. So they underperformed for about 20 years into the early 2000s. They then outperformed for 10 years. They then underperformed for 15 years through 2024. And here we sit. Now on the right side, we've got the blown up version, which is really just that kind of right edge right here. And you can see they have turned upwards. They really started to relatively outperform when Trump was threatening all the tariffs and starting all that business. So that actually ended up being very good for the strength of Toronto, which again is not always what people would want to assume, but that of course is what I'm always on about. Because here's the Toronto stock market, and we've gone through all kinds of negative things happening. In fact, there are lots of negative things happening. Talks about recessions and falling GDP and GDP per capita is weak and all this tariffs and possibility the demise of the Canadian dollar and housing prices. It just doesn't matter because the stock market is rising. The trend and the supply of stock sellers is less than the demand. And so that is the reality, is that a trend can exist for longer than we can certainly make sense of it, to say the least. But bigger picture, we have to understand what's happening, right? We've got monetary expansion through the supply of money, and it goes into asset prices, but some asset prices are being deemed rather expensive. Housing, all kinds of stuff going on here. So here's residential prices are falling. They've been falling for the last several years in Canada now. On the bottom left here, we've got the average house price that is trending down with a moving average there. We got a lot of power of sale listings. So again, this is what goes on in Canada. Power of sale when suddenly the lending institution stands in, takes control and sells these houses. And this is what's happening. These are the average number of listings that are happening here. You can see the rise over the last several years. So again, we've got a very significant year in front of us in 2026 as mortgages renew at much higher rates. But again, we got lots of negative things going on in housing. That is to say the least, especially in the nearby city of Toronto. But again, bottom line is the actual stock markets are getting stronger despite all that news. And so again, you can see here's the Russell 1,000 companies. This is actually the largest percentage of 52-week highs since 2024. And again, more highs than lows is a good thing for the market. There aren't enough stocks going down to bring the market down because the market requires more broad-based selling for the most part to push things lower. Again, you can see that here, using advanced decline lines, we've got the large caps in the top and the mid caps in the middle and the small caps. Advanced decline lines are rising. So again, more stocks rising than falling, and that is a bullish characteristic. Now, semiconductors, very, very important sector. Yesterday we had Taiwan Semiconductor announce earnings, and the earnings were received positively. The stock was up a bunch, and in the bottom left there you can see. On the right side, I've got Broadcom, which was a very large holding from our perspective, client perspective, is no longer. And then in the bottom, we've got NVIDIA, which is actually the largest stock in the world. And you can see that those two stocks on the right side are not keeping up. And so relatively, in the recent months, they have weakened. And what that means is they're not exactly going down, but they're not going up. Like KLA Corp, which was actually the largest gainer yesterday, up about 8%, and Taiwan Semiconductor, as already mentioned. So again, we can always observe strength in absolute trend and in relative trend, and I think that's what we want to continue to do as we adjust, because again, the market is indeed changing. Now here's Nutrien. This is a dual listed stock. Some of you may better know this company as Potash or Agrium. These merged some time ago, and so the bottom line is they're coming back to life. That is a multi-year breakout that happened on Wednesday, and again, I remember the old mantra that everybody has to eat. That, of course, was the reason why these stocks would not bother going down like the rest of the market in 2008, but that did not turn out to be the case. They certainly fell, and they fell precipitously. Let's look at industry focus here. Just look at uranium stocks. Again, Cameco being the largest producer. You can see the green circles there, kind of is where we stood in and bought the pullbacks, if you will, from our perspective. Cameco is the largest. These are volatile stocks. Energy Fuels on the right side, much more volatile stock. But the bottom line is that, again, when industry groups that are relatively strong to the market correct, like all trends, I want to have the opportunity to not only identify those pullbacks, but also consider taking advantage, because I consider pullbacks against the trend to be a lower risk entry point, and that is exactly what took place in uranium. Just look at a couple of the ETFs here that we've owned for some time now in the All in Sync pool. You can see on the left side, we've got a Canada Momentum ETF, WXM. On the right side, that is the mid caps in Toronto. You can see the top circles, both of those hitting brand new highs pretty much every day these days. And on the bottom panel, we've got new highs being hit every day, and that is versus the Toronto stock market. Now, why the Toronto stock market? Well, I already showed you the Toronto stock market recently has been stronger than the US. So let's compare it to the strongest of the denominators, and that is exactly what we want. We've got ETFs here that are outperforming relatively, and they are going up. And again, I would argue that is exactly what investors should want. Let's finish off a sector watch here. The energy stocks have had a bounce back after the last week's Venezuela news, but the material stocks, again, everything in between, like Net Nutrient and certainly the gold stocks and whatnot, have been continue to be very strong. You can see the Canadian technology sector down 3.3%, not a very diverse sector. Either way, this is where we sit as we head into the next week. There will be a new blog post out. The InSync angle will be coming out, and it's I want to talk about bubbles, and are we in a bubble? And my, of course, cheeky comment on that will be absolutely, but it's not necessarily what you think. I hope some of you managed to catch the Investing with IBD podcast that did this week. Talked a lot about biases, which again, I think is a very, very important part of the mental side of investing. And I hope you had a chance to check that out. Please follow me on X. I'm at David Cox RJ. And thanks again for your time this week. This has been David Cox, Portfolio Manager at Financially in Sync in Waterloo, Canada.